Is it possible that the United States government may simply choose to just not pay the national debt? Well, technically anything is possible. So let's take a look at a few potential outcomes if the United States government, for one reason or another, decided to stop making payments on the national debt. First, it is important to note that the United States national budget deficit is about $1.9 trillion year to date, which is up 24% compared to last year. If you don't know what deficit means, it's the difference between the money you take in income and the money you spend. So for your own personal situation, if your paycheck is 10 grand, but you spend 15 grand, well, 5,000 of that you had to put on a credit card. It's the same thing for the United States government. They take money in taxes, then they spend money. They always spend more than they take in taxes. So the difference there, they have to borrow, they have to use debt, and that amount is called the deficit. Now, $1.9 trillion sounds like a lot, but when we put it in historical light, we see that for basically all of US history, the deficit has done one thing only, and that is get bigger. And especially it's gotten bigger over the last 24 years. Since 2001, which was the last year the United States ran a budget surplus, we have seen severely deteriorating finances from the US government pretty much every single year since then. Part of the reason for this is the growing cost of the debt itself. We see the national debt is now at $35 trillion, but that's not just $35 trillion that the United States owes to various countries and institutions around the world, because it's not like they can just tax $35 trillion from the economy to pay it all back. Essentially what they're doing is paying off whatever debt that comes due by borrowing new debt. This is why the total national debt continues to grow every single year, because every year they take money in taxes, they spend it all, and then they spend even more that they borrow, and then they've got old debt that they have to pay back. They borrow some extra money just to pay off that old debt. And as if that doesn't sound bad enough, we also have to take into account the growing cost of just keeping that debt pile around, which is the interest on the debt. The interest on national debt has been ballooning over the last couple of years, and it is expected to hit $2 trillion per year within just the next few years. To put that in perspective, the interest that the government is paying on the debt right now is the third largest item on the budget, and pretty soon it will be the first largest item on the budget. So what would happen if the government just said, we're done. We're not paying any of this back. We are just going to default by choice. Anybody that we borrowed money from, sorry, you're out of luck. Well, the very first thing that would happen is anybody who did own debt, money that they lent to the US government in the form of a US Treasury bond, they would try and sell that debt to somebody else. Now, obviously, at this point, the likelihood that that bond gets paid back is almost zero, because the government has just said, we're not paying back the debt. So nobody's gonna pay full price for this debt, especially given the fact that everybody in the world is gonna be trying to sell it. So the price of US Treasury bonds would collapse. Might go to 10 cents on the dollar, might go to 5 cents on the dollar, might go even lower than that. We know that interest rates on bonds are inversely correlated to the price of bonds. And so with the US 10-year Treasury yield currently at 3.6%, it would send the interest rate absolutely soaring. This means two things. Number one, anybody who had lent money to the US government gets completely wiped out. If you lent a couple $1 million in the form of buying US Treasuries and you were hoping to get that couple $1 million back with interest, you're probably gonna get none of it back. If you're lucky, you'll be able to sell that debt to somebody else for maybe a couple $1,000, but most likely you get nothing. Now you're probably thinking, well, the interest rate on that debt would then go to infinity. If you're gonna get $0 back, then there is really no interest rate on it. And that is true, but the interest rate on the US government being able to borrow more money in the future, if they ever tried to, would be astronomical, because they just defaulted on 35 trillion. The likelihood that they might default on new debt that they try and borrow in the future would be very, very, very high. So any lender would demand an enormous interest rate from them, which means the government from then on would basically not be able to borrow a single dollar ever again. And by the way, if you're looking for somebody to walk you through exactly what comes next for America, and more importantly, what you can do about it, you need to subscribe to my brand new newsletter, Letters from a Heretic. It's the only place where I'm going to go deeper into some of these topics that I seriously doubt you're gonna hear about from anyone else. As soon as you sign up, you're gonna start receiving my 5-day series called The Most Dangerous Ideas in America. These are ideas so powerful they could reshape the economic landscape of our nation. We talk about things like the real reason we could be on the verge of World War III, The Rise of the House of Saw, The True Location of the Financial All-Seeing Eye, a secret manuscript that predicted the end of America and what it means for your wealth. We talk about America's coming dark summer and even the final phase of the US dollar. So if you're interested in receiving that so you can make better decisions about how to grow and protect your wealth, especially during times of crisis, click the link below, enter your email, and I'll start showing you everything I know. Now, if you remember earlier, we talked about the national deficit currently being at $1.9 trillion, which means right now the US government is spending so much money on everything it spends money on that it cannot tax enough in order to spend that. It has to borrow, which means if the government defaults on its debt, even if it's by choice, they would also be forced to cut spending because they wouldn't be able to get enough money to continue doing all that spending. So essentially, a default on the debt would also mean a resizing of the government smaller and just stopping paying almost all those bills. Now, if it stopped here, it would actually be great because in reality, the government is not paying back lenders with the full purchasing power it borrows. It's paying back lenders with dollars that are worth less than the dollars it originally borrowed. And so in real purchasing power terms, the government is actually still defaulting every single day because it's not giving back what it borrowed, as long as you measure it in real purchasing power terms. The difference is the economy is getting swindled, and people don't normally realize how much of their wealth is getting transferred to the government every day through this sneaky process. And so the government defaulting on its debt outright and being honest about the fact that it actually cannot pay it back would be better for the economy. It would resize the government smaller. They would stop being such a big burden on the economy. They would stop being able to siphon away so much wealth, and the economy would boom. Yes, there'd be short-term pain, for sure, some deep pain, but overall, afterwards, over the long term, it would boom. There would be massive strength. Now, don't get me wrong. There would absolutely be pain, but most of that pain would go to the lenders. Anybody who had bought US treasuries, lent money to the US government, they'd be almost completely wiped out. So you're looking at central banks around the world, you're looking at sovereign wealth funds around the world, you're looking at banks and institutions. You're not really looking at the average individual. Now you might say, well, hey, hold on a second. If the banks go under, because that was where all their wealth was being lent out to the government, then we all get screwed as well because they have our money. And so if they took our money, lent it to the government, and they go under, all of our money disappears too as well. And that is mostly right. However, the vast majority of Americans don't have any savings at all. So the vast majority of Americans would experience very little loss as a result of this. Now, there would be a good portion of Americans who do have a lot of their net worth in savings in banks, and they would absolutely be affected. There's a fantastic book called The Forgotten Depression by James Grant. I recommend everybody read this because there was actually a depression in 1920 and 1921 that most people have no idea about, and it was a deflationary death spiral type of depression, very severe, very steep. But the difference was the government didn't try and do anything about it. The Federal Reserve didn't lower rates to try and stimulate the economy. The government didn't try to borrow more and try and spend and grow the economy that way. They just did nothing and let everything collapse. And guess what? It was followed by some massive boom years because the economy fixed itself. And that's exactly what would happen here if it stopped here, which is a big if, and I'll go into that in a moment. But if it did stop here, the government just outright defaulting and then having to go back to spending only what it could take in taxes, not being a tumor on the economy, would set the stage for some massive, really, really healthy, strong growth for the country moving forward for decades. But as we all know, it probably wouldn't stop there. So there are a couple of options on how it would play out from there if the United States government just said, we're gonna default. Path number one would be that the Federal Reserve would step in. This right here is the Federal Reserve's balance sheet, and their balance sheet, you can think of it like their brokerage account. With your brokerage account, you take your cash and you buy assets like stocks and mutual funds. With their balance sheet or their investment account, brokerage account, they print money and they use that printed money to buy assets like US government treasuries and mortgage-backed securities. Right now, their balance sheet is worth about $7 trillion, which means they've printed $7 trillion to go buy assets like US treasuries. In other words, those dollars have been loaned to the United States government for the government to spend. If the Fed stepped in here, you would see their balance sheet spike to an unprecedented level, potentially buying all of the national debt from around the world. So it increased to a level of around $35 trillion higher than wherever it is right now. And they would buy up all of the debt that everybody else is trying to sell. Now, if the Fed is stepping in, it's because they don't want the massive calamity to happen, the deflationary death spiral that would happen, the government having to shrink its expenses and get smaller if the outright default were to be allowed to happen. So the Fed wouldn't be buying this debt at pennies on the dollar. They'd be buying it at full price, knowing that they're not going to get paid, but it doesn't matter because they just print the money they need anyway. So all of that debt, the $35 trillion of US government debt around the world, would get sold to the Federal Reserve and it would be replaced with dollars. Now, this would be a really, really bad scenario here because it would essentially very quickly tip over into hyperinflation. If the rest of the world tries to get rid of debt, which is basically dollars that pay interest, they definitely won't want the dollars because everybody would realize, hey, now everybody's liquid and nobody wanted the debt before. Nobody wants these dollars. The only thing that we can do with them is send them back to the US in the form of buying stuff from the US, which is going to be our assets, like our real estate and our stocks and goods, inventory that we have on our store shelves. And so there'd be a rapid flood of dollars, trillions and trillions of dollars back to the United States from around the world. And that would bid up the prices of all of our assets and goods and services. And so if the Fed did step in with a massive program of QE in order to fully monetize the national debt all at once at full price, it would essentially result in a complete collapse and hyperinflation of the US dollar. It's important to note that this is also why the US government just doesn't tell the Fed right now to help them out with paying off the national debt. It's why they don't just print the money in order to pay for the debt, because everybody would then realize, hey, this debt's not going to pay me a real return, so I got to get rid of it. The dollar is going to hyperinflate. It's why nobody owns Zimbabwe debt and Lebanon debt and Turkey debt. It's because your odds of being able to get back your real purchasing power are extremely low. So if we just started tapping on our central bank in order to pay off that debt for us, it would undermine the quality or the trust in it, and it would spiral out of control into hyperinflation very quickly. This is why we don't see things like the $1 trillion coin being talked about as a serious idea, except by some MMT Looney Tunes and fun thought experiments. If push comes to shove and they actually had to because everybody was already dumping it for one reason or another, then they would monetize all the debt. But it's never going to happen just by choice. So if push comes to shove and the Federal Reserve was forced to buy up all the national debt, basically, even though the national debt still exists because the Fed owns it, and the government now owes all that money to the Fed, it removes the burden of that debt. Right now, the interest on the national debt is about $1.2 trillion per year, and it's growing rapidly. But what happens when all of that interest is owed and paid to the Federal Reserve? What does the Federal Reserve do with it? Well, normally the Federal Reserve will receive profits from all the assets on its balance sheet. Remember, they've got $7 trillion worth of assets that are paying them interest right now, things like treasuries and mortgage-backed securities. So normally, even after paying for all of their expenses, they have a profit left over. By law, what the Federal Reserve does with those profits is send them back to the US government, back to the US Treasury. So it's not allowed to just keep those profits for themselves. They don't just hand those out to all the bank owners. Contrary to what you might hear, the Federal Reserve is actually part private and part public. And this is one of the ways that works out. After paying all of its expenses, including dividends to its banks, yes, it does do that, but it sends the profits back to the government after that. However, if we look at what's been happening recently, this chart just drops off of a cliff. This is a little bit deceiving because once this number goes negative, it turns into a cumulative number. So back here, when the profit number is positive, this is a weekly number. So it's the amount of money the Federal Reserve is sending back to the US Treasury every week. But once the number turns negative, it becomes a cumulative number, meaning right now they're sitting at a cumulative number of about $200 billion that they are in the hole in terms of not having sent that to the Treasury, but they have printed that to cover what they need to spend. But if the Federal Reserve were to monetize the entire national debt and their balance sheet was worth $35 or $40 trillion, then they would have profits yet again, but those profits would just be sent back to the US government, which basically means this $1 trillion to $2 trillion that the government is spending every single year on just the interest on the debt essentially becomes zero because they pay it to the Fed and then they get it almost all back. So because neither of these scenarios are very likely, either the government just outright saying we're going to default and then sticking to it, or the Federal Reserve stepping in to print the money so that the government can just pay off all the debt with printed money, since neither of those two things are going to happen, what is likely to happen instead? Because we all know the current path we're on is unsustainable. This is a hockey stick. Just the cost of keeping the debt alone will soon become too much for them to afford. Well, step number one is the Fed starts lowering rates. If the Fed is able to lower rates a few times in a row, then the cost of short-term debt for the US government will start to go down. Right now, most of the debt the US government has is at the short end, which means if the Federal Reserve lowers rates right now and is able to continue doing that for at least the next couple of meetings, then as that debt matures and the government has to pay it off, they'll be able to replace it with new debt that is cheaper. But this is a short-term fix, not a long-term solution. The next thing is the Federal Reserve will stop its quantitative tightening, which means its balance sheet will stop declining and it'll just move sideways. And then they will probably resume QE, which means the balance sheet will start to grow again. Again, this just means that the Federal Reserve is printing money in order to buy US debt from the market. So they replace that debt with cash, and then that cash is able to make its way back to the government in the form of a new loan. Both of these things essentially allow new dollars to make their way as a loan to the US government for them to spend those new dollars into existence. It allows them to keep on spending more, driving up inflation, driving prices higher, which then, ironically, drives interest rates up for everyone else. Because if inflation goes back up to 4, 5, 6%, what do you think mortgage rates are gonna do? What do you think credit card rates are gonna do? It doesn't matter that the US government gets a cheaper rate to borrow at. If inflation starts moving higher again, interest rates for the debt for all of us will start to move higher again. This is called an inflationary deleveraging, and it's the exact playbook the government followed from about 1940 through about 1980. The US debt to GDP is currently around 120%, which is the same place we were right at the peak of World War II, when the government was faced with the exact same situation they're in right now, needing to deleverage, but having too much debt relative to the size of the economy to do it normally. So they engaged in an inflationary deleveraging, where they basically printed money in order to grow the size of the economy relative to the size of their debt load and got the debt to GDP back down to about 30%. Keep in mind, over this same time frame from about 1940 through about 1980, interest rates actually rose and inflation did as well. They were able to do this in conjunction with the Federal Reserve, who did things like yield curve control in order to make sure that the government was able to borrow at rates that were below the rate of inflation, driving the supply of money higher, offloading that load from the government onto the economy, making the economy pay for it through inflation. So the government was able to deleverage by using inflation. Back then, people couldn't protect themselves by buying things like hard assets. In fact, it was actually illegal to own gold at that time if you were a US citizen, and you didn't have access to things like Bitcoin, obviously, and even most stocks. It was pretty difficult for the average person to invest in stocks. There were no things like ETFs and low-cost mutual funds, which means today the average person is in a little bit of a better spot actually, because you have more access to ways to protect your wealth. Obviously, you can buy gold, it's not illegal. You can buy Bitcoin, it's not illegal yet. You can buy things like stocks, which historically perform very well during times of heightened and extended inflation. Just look at the stock markets of places like the Weimar Republic in Germany, Venezuela, because you're buying assets that produce cash flow and that produce profits. You're able to protect yourself at least somewhat from inflation. And especially things like real estate, as long as you buy them by shorting the dollar, which means you're borrowing a fixed rate long-term debt like a 30-year mortgage in order to buy cash flowing real estate. These are all things that perform very well during periods of times like this, historically speaking. If you'd like me to help you apply ideas like this to your own investing, click on the link in the description below. As always, thanks so much for watching. Have a great day.